All right, everybody, it is Simon and Erin time. This is a great opportunity because we're going to learn about joint ventures from you, Simon. Mm-hmm. All right, let's get going. So talk about what is a joint venture deal.
When you talk to rookie investors, it sounds intimidating. It sounds complicated. And all a joint venture is a joint venture could be 2 or 3 people getting together and purchasing a piece of real estate. Now, joint ventures are not typically used to buy a house or buy a single family rental. They're typically used to buy larger deals. It may not be typical for somebody to buy a $2 million or $5 million or $10 million commercial endeavor. But sometimes, for example, we've had a couple of doctors get together and buy a medical building. They each have units in the building, and collectively they also own it as an investment. So it just means 2 or 3 or more investors getting together on a venture and buying together. That's it.
Okay, now how are they structured?
Well, there's a lot of different ways they can be structured. You could do a regular corporation, so you have shareholders. I own 50%, you own 50%, or we could have a third, or I could have 10%, and you could have 90%. It's whatever you decide. Or you can get into more complicated partnerships and limited liability partnerships. And I don't want to go into the legal breakdown, but it could be any number of different ways.
And legal representation would be great.
Legal representation is a requirement. I mean, we call it ILA, get your independent legal advice. And when you get into joint ventures, it gets a little more complicated. So, for example, if let's say XYZ Corporation is the company that is acquiring the real estate, then the XYZ Corp needs a lawyer. But then you, as an individual investor, being a shareholder in XYZ Corp, you should get your own lawyer to represent you in your dealings with the corporation of which you're a shareholder.
All right, let's talk about the pros and cons of joint ventures.
Unlike buying a regular piece of property where you call the shots. You want to put a new roof? You put a new roof. You want to sell it? You sell it. You want to keep it? You keep it. All of a sudden now, when you're in a joint venture, you need to understand exactly what the exit strategy is. How long is your money tied up? What happens if there's a disagreement? And you have to deal with all of these different things. What happens if there's a disagreement with the shareholders? You and I are friends right now, but if we're dealing with millions of dollars and you need money, you might get a little aggressive, and your friendship is in jeopardy. So you got to be very, very careful. You got to address a lot of different things. What happens if you disagree? What happens if one party wants to sell and the others don't? Or what happens if most people want to sell, but one wants to hold out? Is there a provision for voting? And, usually a shareholders agreement, other structures like that have those provisions, but you want to make sure. What happens if one of the partners, God forbid, passes away? Yeah. Should you have life insurance to address the situation? Do you have a provision where if somebody passes away or gets, again, God forbid, really sick and unavailable, unable to participate as the investor should? How do you address those different things? And this is why you need to have a lawyer that has experience in this stuff and can tell you what you don't know that you don't know. Anybody can read a contract, say, well, it looks okay to me, but you need somebody who has experience with JVs, joint ventures, is experienced with shareholder agreements, and dealing with all of the different what ifs. In any business or real estate deal, the problems arise when you haven't addressed all of the what ifs.
All right.
If you address all of those, you sort of mitigate the potential damage.
Okay, let's talk about the types of deals that you can do a JV with.
You do it pretty much anything. I mean, we've seen them with, joint venture with acquiring companies. You might have, for example, a marketing company and a media company. You might have a property manager partner up with a realty firm to acquire a property. So, it's endless. You can buy any kind of property and any kind of business, and it's just a way to work in concert with other investors.
Does it allow people that maybe wouldn't be able to do so on their own, or maybe they are risk adverse? So this kind of gives them a sense of comfort that they have other people with skin in the game, other people with money. It also allows you to make a purchase that you probably couldn't do maybe on your own, but you got just enough to contribute with other people. Yeah,
there's a lot of that too. But the other thing too is it's another way for people to diversify as well.
Okay.
So look, I've got $500,000. I could probably acquire this property on my own, but why not bring in 4 of my buddies? Let's do this together, and then we can acquire 5 properties collectively.
As opposed to just one.
Opposed to, I'm going to buy this by myself. Yeah. And, it's a way to mitigate risk, maybe diversify. But you're right. In a lot of cases, it's a way for people that don't have the resources to buy a big deal to get a small piece of a big deal. We've talked about different kind of syndicated investments. Those are not necessarily joint ventures because you're one of a small syndicate. You have very little control, really.
You're passive.
You're passive. You have a fixed term. With smaller joint ventures, it's a little bit more control.
It's a wonderful wonderful opportunity in this great game of Monopoly. I mean, that's what real estate's all about. It's just what piece do you want to play and how much do you want to buy?
People get intimidated. And, I'll tell you a funny story. I'm literally playing Monopoly with my boys. And, Joey looks at me and he finally clued in. He said, so when I have property, I collect rent? I said, yep. He said, well, we should buy lots of them then. And he's finally clued in that the more properties you have, the more rent you collect. So, but you need to have some cash to buy the hotels and buy the houses, and you know how to play Monopoly. And people just get so intimidated. But when you break it down, it's actually very, very simple if you do it correctly. You need the right legal advice. You need to know what your long-term plans are. You have to try to stay away from what I call paralysis by analysis. Some people analyze everything to death and analyze themselves out of a deal. They're looking for guarantees. You can't get guarantees in life, but if you know that, for example, the real estate market has gone up, on average 7% a year for the last 50 years, it's fairly likely over the next 30, 40 years, it's going to do the same. There's going to be ups and downs, but joint ventures are a great way for people to diversify, to get into larger deals that they wouldn't, necessarily have had the opportunity. And it's a great learning opportunity because all of a sudden, when you get involved and you've signed a joint venture agreement and you've signed a shareholders agreement, that's yet another thing that you're no longer new to and afraid of. And then it just opens up so many other possibilities.
Now, could you give an example of something that you're currently working on or that you've helped people in terms of doing a joint venture opportunity?
Yeah, actually, we're working on one right now. It's a great opportunity we found. It's actually a development site, which is rare to find. This is a unique case because it's rare to find a development site with income. So usually you'll find, for example, a piece of land along a highway strip, and the path of development is fast approaching this piece of land, but it's not yet ready for development.
Okay.
So you need a buyer that's going to be able to park their money and sit and wait 3, 5, 7, 9 years. Every situation's different. In this case, we're working on one in the GTA, very, very strong area. Lots of development going on in the area, probably 5 to 7 year hold in this case. But in this case, it's a piece of land that actually has a solid tenant with income locked in for the next 12 years. We're talking about an international company that's guaranteed to pay rent. So in this case, call it a $2 million deal.
Okay.
So with the $2 million commercial deal, you need to come up with $700,000, $800,000 down sometimes, and not everybody has $700,000 or $800,000 down. I call them the rookie investors. Might have $50,000 or $100,000 or $200,000 to invest. They're either pulling it out of their GIC or they're pulling it out of their home equity line of credit, and they'd love to get into this kind of a deal, but they don't have the resources to do the whole thing. So this is a perfect opportunity. In fact, with this one investment opportunity, we still have space for a couple of investors. We've got quite a few people already committed to participating and investing their money. We've got room for maybe 1 or 2 more people. Time is short, so if you're listening in, you're really serious about this, give us a call and we'll get you the information. But let me tell you more about the deal. Essentially, it's set up so that it has cash flow. So what do I mean by that? Once the investors put in their down payment, then the rent from the property is carrying the financing on the property, and there's no cash calls required. In other words, you don't have to put any more money in. It's a very simple property, so there's really no expenses because the tenant is covering all of the expenses. There's really no ongoing expenses other than annual legal fee, annual accounting fee, a couple $1,000s. So this is a great opportunity for somebody that wants to get involved in a commercial development deal. And when we get into these development deals, we see huge upsides, Erin, as you know. Typically you invest for 15, 20, 25% returns on a little income property. When you go into development sites and you go from a piece of land to a high-rise development, you're now talking in a short period of time, 7, 8, 9 years, you might get 4 times value.
That's right.
5 times value, 6 times value. We have really no way of knowing. But at the same time, it's a solid investment because you're investing in land in a prime area and you've got cash flow covering the debt. Even if nothing happened and we just paid off the debt, the return would be phenomenal. Would be, double-digit returns. So very, very safe investment. So if anybody's seriously thinking about and wants to learn about joint ventures, I strongly suggest you give us a call. We'll let you know about this deal. Just ask about the joint venture deal, and you can call our help desk, 416-366-9090, or go to realestatetalkshow.ca, and we've got a complete information package, and I'll personally walk you through anybody that's curious about this. But the time is short on this one, so I would, write down that number, call us right away, and we'll get you the information package on
All
that.
right, so everybody remember, 416-366-9090. And this is a great opportunity because you heard it from Simon's mouth. He will actually talk to you and deal with you directly. That's just a reason to call right there.
And there are some other opportunities out there. So I think we covered everything on joint ventures.
Keep blazing trails, Simon.
Absolutely.